Next, we move our attention to valuing our inventories and appropriately recording the cost of goods sold. In this module, we will learn about different ways that we use to value our ending inventories, how that affects our taxes, our financial reporting, and future accounting periods as well. Let's identify the items that make up merchandise inventory. We talked about this a little bit earlier. We're going to go into a little bit more depth. So we talked about the goods in transit, whether it's FOB shipping point or FOB destination. FOB shipping point, remember, meant that title transferred from the point it was delivered on the shipper's dock. So if you are the buyer, you own the goods at that point, and that freight belongs to you as well as the risk of transport. FOB destination means that the seller guarantees the goods until they arrive at your dock. The seller is responsible for the freight. The seller bears the risk of the goods during transit. Goods on consignment means that the owner of the goods has asked you to merchandise and sell them for them. The consignor is the person who owns the goods. The consignee is the person who is selling the goods. So you'll see maybe some consignment shops for antiques, artwork, those kinds of things. The owner is the person who owns it. The consignee is the person who runs the store to sell the goods. That merchandise is included in the inventory of the consignor, the person who owns it. The consignee never reports consigned goods in inventory, just an agent. Damaged or obsolete goods are not reported in inventory, so if we have something that we were using or selling that no longer has value, we remove it from our inventory. If it's damaged or has some resale value, we report it at net realizable value, which is what our anticipated sales price is minus any selling costs. Any losses that we have due to damage or obsolescence are recorded in our general journal and ledgers. Let's take a look at number 1 in our practice set. I'll encourage you to work through it on your own and see how you do and come back and walk through it with me. Hopefully you had a go at the problems in number 1. Let's take a look at QS 5-1. Here we've got Homestead Crafts that makes and distributes homemade gifts operating out of her home. She has 1,300 units in her basement and 20 were damaged by water, 350 units in her van to be delivered, terms of FOB destination, and 80 units out on consignment. How many units should Emma include in her company's period end inventory? Well, we have all of the units in the basement, right? So let's just bring those in. Units in basement, 1,300. But we know that we have some damages there. So we'll take those out. So minus 20. The goods that are in her van, it's FOB destination. That means she owns them until she delivers them to her customer. So we do include those. That's 350 units. And the units on consignment, she is the consignor. She has them on consignment with a friend, so those are hers. And that is 80 units. So in total, we have 1,710 units that she should include in her inventory. In QS 5.2, we have a car dealer with terms FOB shipping point, and we're to determine the total inventory costs assigned to the used car that was purchased. So our first cost that we know is what it costs to acquire that used car. We call that the acquisition cost. And that amount was $14,000. We're going to add to that some, whoops, not 140,000, excuse me, 14,000. We're going to add to that some additional costs. So which of these costs should be added to our inventory? The transportation in, yes, it's FOB shipping point. So the shipping costs are ours. We own it from the shipper's stock, $250. How about shipping insurance? Yes, because it is ours, we bear the risk, so we're going to insure it from the point of the dock to from dock to dock. So 300. How about the car import duties? Yes, those are additional costs to get the car ready for sale. So 900 on those. $150 for advertising. No, that's not a cost of getting it ready for sale. That's a cost that we incur when we're trying to sell it, but not readying the good for sale. The same with the $1,250 for sales to the staff. Those are costs that we incur trying to sell the good, but not getting it ready for sale. Trimming shrubs, that's maintenance of our building. That does not have anything to do with the cost of the car, so we won't include that either. So the total costs that we include in inventory are $15,450. In exercise 5-1, we're being asked to identify the ownership of the inventory goods. In the first problem, we are asked, who should include the $12,500 of merchandise in transit as part of their inventory? We'll see that the bar company shipped its shipping FOB destination to Lee Company. So bar company is the seller, Lee Company is the buyer. It's FOB destination. That means that the goods are owned by the seller until they are received by the buyer. So the owner of the goods at that time and the person who includes it in their inventory is bar company. In number 2, Paris Company shipped goods to Harlow, who arranged to sell the goods for Paris. So Paris is a consignor, Harlow is the consignee. So the consignor is Paris. Sorry, that doesn't come up. Oh, I'm going to have to fix that. The consignor is Paris. The consignee is, so let's just do that below here because we know that's correct. The consignee is Harlow Company. And which company includes the goods in inventory? Seems we lost Paris there, so Paris is the one that includes the goods in inventory. That concludes lesson 1.